Hello everyone, my name is Eddie Hood and I am one of the founders at Ignite Spot Outsourced Accounting. Today we're going to talk about how to control your costs. Now this is something we get asked all the time. So we've got something up here. Now if you can't see this, it's kind of small, I know. We've got a picture of it in the blog post down below so you can kind of zoom in if you want. But what we're going to do today is give you some really practical tips on how to get a hold of those costs as a business owner so that you don't magically run out of cash, okay? Now, a few things about the terminology. You've heard about fixed versus variable expenses. I want to talk about that first and make sure you have a really good grasp on that. So up here we've got fixed versus variable costs. And down below you can see we've got some red arrows. And under the fixed term here, we've got the word changes and it's crossed out. Obviously, they're called fixed costs because they don't change. These are the costs that you have in your business like rent, insurance premiums, your marketing budget might not change. That might be set every month. They're costs really that don't change based off of how much you sell in your business. Regardless of how much product or service you sell, those costs are always going to be there, okay? Now, variable costs are different. If you look down here, I've got the word changes circled in green. These do change, and they change all the time based off of how much you sell. So let's say that you sell watches. I got a fancy new watch here I just bought. All right, so you sell watches, and this is one of those triathlon watches. I'm getting into triathlons, and I don't know how well that's going to go, but hopefully this will make me better at it, right? So if you sell these things, you've got to pay for the band, this rubberized thing. You've got to pay for the glass on the front, the computer inside, the clasp on the back, okay? And these are all cost or materials. Now those are variable costs because every time I sell a watch, I got to buy a new band, new glass, new computer, new clasp, all of that stuff. So common variable costs include material, the labor that goes into putting the product or service together. So if you're a lawn mowing company, the cost of your guys that go out and push the lawnmowers around, that's probably going to be a variable cost for you because you wouldn't pay them if you didn't have lawns to mow, all right? Depending on how your business is set up, of course. So that's a variable cost. Now, I want you to really get a good solid understanding in your business of what your fixed costs are and your variable costs are. So one thing you can do with your accountant is have them print out a list of the costs that you incur every month and have them organize them by vendor. Just put my watch back on. Have them organize the costs by vendor. And if you do that, you can go down and say, this vendor is a cost we incur because it's always there. But this vendor, we incur costs because we're buying product. So just kind of, categorize them if you can for me. Put your fixed costs on one side, your variable costs on the other. That way you'll know next how to control those costs, okay? So I've got a few tips over here. Number one, have your accountant create a weekly transaction report. Have them print out all of the transactions that you incur. At Ignite Spot, we do this every Thursday. Our bookkeeper prints off all of our transactions that hit our credit card, they hit our bank accounts, all that stuff, and I get it in one big report. And once you get that report, as the business owner, just scan down it and look at all of the vendors that you're paying. What this is going to do, number one, is make sure that you're not paying for stuff you weren't aware of that you were paying for, which, to be honest, happens quite a lot. You'd be surprised at how many people are dinging your account and drafting money and pulling money out. And unless you look at that report, you're not going to be able to control those costs, okay? Number two, you'll want to create a budget, obviously, but enter it into your accounting software. A lot of business owners have actually created a budget, but they haven't taken the time to put it into their accounting software. And the benefit of that is that as you incur costs throughout the month, your software will grab your current costs and compare them to your budget, and obviously create a budget to actual report for you that you can analyze when all is said and done. But if all you do is create a budget and keep it in an Excel file somewhere, it's not going to be very useful. In fact, it's one of those kind of plans that die. You create it and then you forget about it because you get too busy. But if you take the time to put it in your software, the software will do the work and it will track your budget to actual. And then you can print out that report once a week or once a month and review it and see where you're overspending. Number three, know the benefit of the break-even analysis when you control your costs. So if you don't know how to calculate break-even points, we've created a separate video on how to do that. I'll include the link in the blog post down below. But we're going to walk through a quick example here. So I've got two different examples. The top line here, again, if you can't see it, I'll read it to you. It says revenue. For both situations, it's $100,000. We're assuming the business is $100,000 in sales. Now, when you take out the variable costs, or as accountants like to call them, cost of goods sold, Again, your material, your labor for those the product or service, all that stuff, it comes out. In the first instance, this company is spending $50,000 for their variable costs. Okay. Now we'll go down the next instance here in just a second. But after you take out the $50,000, that gives them a gross profit of $50,000. 100 grand less the 50 grand leaves $50,000 left. That's their gross profit. Now that creates a gross margin of 50%. All you do is you take your gross profit, divide it by your revenue, that gives them 50% gross margin. I know this is there's a lot going on here, but this is important. You need to know how to do this as a business owner. Once you know what your gross margin is, you can then look at your overhead, and in this case, we're creating a pretend example that it's $25,000 for company A, okay? To figure out this company's break-even point, what you do is you take their overhead and you divide it by the gross margin of 50%, which creates a break-even point of $50,000. Now, watch what happens if you own this business. If you make just a few small changes to your variable costs and your fixed costs, watch what happens. So we're going to say that their variable costs go from $50,000 down to $40,000. In my mind, maybe this company sells a product that costs them $5 to make. And maybe they sell, X number of them, but if they can go from $5 down to just $4 as a cost per unit, then they could make a change like this in their business structure. So going down to $40,000 for their variable expenses, that means now their gross profit's $60,000. Okay? If I take that $60,000 and divide it by the $100,000, that gives me a gross margin of 60%, which was 10% better than the other company. Now, so what we've done is we've decreased our variable cost by $10,000, or we're pretending that's $1 per unit. And if you work really hard on your product, you probably can save $1 per unit by working with manufacturers, trying to figure out labor costs, anything that goes into that. You could probably scrape out $1. Now watch what happens if we take their overhead and we go from $25,000 down to $20,000. This is an exercise where they sit down with their accountant and just look at where they're spending their money. Again, going back to the weekly transaction report, we're spending money here and we don't need that, so we cut that out. But if you can get $5,000 out of your overhead spend, what happens is their break-even point goes down to $33,333. That's a phenomenal change by making just some small changes. They cut out $5,000 from their overhead, which if you try really hard, you could probably create something similar in your business. And they took just $1 off per unit on their product, going from $50,000 in costs to $40,000 in costs. Few small changes can make such a big difference for a business. Imagine having to sell $50,000 in break-even points, or to break even, or make a couple simple changes, and now all of a sudden you're down to a $33,000 break-even point. That's awesome. That's what we want to get your business to. So again, figure out what your fixed costs are and set a budget. Try to cut out X number of dollars. Look at what your variable costs are and figure out how to get your cost per unit down. And watch what happens to your break-even point. It's great. Last but not least, for tips, I want to talk about, there's just a lot of different softwares out there to make this easy. Most people find that this is great to talk about, but when it actually comes to having the rubber hit the road and you've got to track your expenses day to day and keep track of receipts and all that stuff, it's a big headache. Not anymore. There are so many software products out there. We really, as business owners, don't have an excuse anymore. Jump on your iPhone or on the internet and you can find programs like Expensify. There's just a million of them, okay? So find a software program that works for you, use it in your company to keep track of your expenses and lower that break-even point and control your costs. I hope this helps. Have a great day, guys, and we'll see you next time.